must come down.
Well, we saw it again this week, the truth in that old reliable saying, what goes up must come down. And just last Monday, in fact, the Dow Jones Industrial Average suffered its largest single-day point decline in history. Every other major index saw similar drops, and all this after a month of record gains. We're going to talk about a lot of this today, and especially about one factor behind all the drama, and that is concerns over rising interest rates and what's happening in the bond market. It's time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional-style investing to your portfolio. Hello, everyone, and welcome to the Income Generation. I'm David Scranton. Now, if you've watched this show for a while, you've heard me make the point many times about the sky-high stock market and how it seems to lack fundamental support. In fact, I've likened it to a floating balloon in search of a pin. The question becomes, has that balloon popped? Well, we can't really answer that question on today's show because it's just a little bit too early to tell. But we will answer a lot of questions about the recent drop and about a topic even more important to investors over the age of 50 who are actively saving for retirement. And that is specifically, we're going to focus on interest rates and bonds, past, present, and future. Joining us to break it all down is renowned analyst and publisher of the Gartman letter, Dennis Gartman. And we'll talk with economics writer and housing market specialist, Logan Mohtashami. First, let's look at some of the details leading up to last week's market madness and how bonds and interest rates factored into all this. Punxsutawney Phil may have predicted 6 more weeks of winter on February 2nd, but he apparently didn't see 6 more weeks of a soaring stock market. In fact, it was on Groundhog Day that the recent market plunge really took hold, with the Dow Jones Industrial Average plunging a devilish 666 points. And then things only got worse from there. The following Monday, the Dow lost 1,175 points, falling 4.6%, its largest intraday decline ever. At the same time, the S&P 500 index lost 4.1%, and the NASDAQ fell by 2.8%. Then, overnight, Monday evening, markets in Japan and Australia each lost more than 3%, and stocks in Europe were also lower across the board. So again, all this came on the heels of the stock market's second-best January in history, which saw it add another 6% to the 20% of growth we already experienced back in 2017. So what caused this plunge? Well, to some degree, that depends on whom you ask. Most analysts agree, however, that one sure factor was fear over the potential effects of rising long and short-term interest rates, especially with a new Federal Reserve chief, Jerome Powell, now sitting in charge of those interest rates. We're focusing on the interest rate issue today because it's particularly relevant to people that are part of the income generation, those investors over the age of 50 who've shifted their focus to secure income-generating financial strategies, especially what I call bonds and bond-like instruments. Now, if that's you, the biggest question on your mind probably isn't whether or not a long overdue stock market correction is in the works. You're probably wondering more about the headwind that emerged against fixed income in January when interest rates spiked in conjunction with the market increase. In fact, you're probably wondering whether that headwind is going to continue or perhaps even get worse. Or you may be wondering if this headwind is something unusual or something permanent or something to be worried about. Well, hopefully you'll be able to answer those questions for yourself after hearing all the data and the perspectives that we share on today's show. So let's begin by getting a better understanding of where we are today by examining how we got here. You know, as mentioned, the stock market rose by over 20% in 2017 and then added another incredible 6% just in the month of January. Now, while stocks were rising in the first half of last year, the bond market was also enjoying a bit of a tailwind. Probably remember the old adage, when interest rates fall, bond values rise, and when interest rates rise, bond values fall. Now, granted, that is an oversimplification, but has some general truth to it. Well, after peaking at 2.6% in March, the interest rate on the 10-year U.S. government bond, i.e. the 10-year Treasury, trended mostly downward last year until early September. At that point, it started trending mostly upward, but it did it very gradually. Then in January, as the stock market was breaking new records, the bond market seemed to finally come out of a coma and recognize that with the unwinding of quantitative easing, the 10-year Treasury rate should be much, much higher. With that unwinding, the Fed was selling some $30 billion worth of Treasuries per month back in the open market, increasing supply in order to drive the prices down and to drive the interest rates up. That's why the 10-year spiked from 2.4 to 2.7% in January, causing bond values to drop and creating this somewhat of a headwind for fixed income investors. And when I say somewhat of a headwind, I mean just that. And I'll explain that in just a moment. But first, I want to stress that none of this is really anything new. In fact, I've been specializing in fixed income for 20 of my 30 years in the financial business. And what we're seeing now is actually quite normal. The stock market, the bond market, interest rates, all zig and zag. Trying to predict those zigs and zags and to make investment decisions on that basis is called market timing. And it's not something that most investors, or even professionals for that matter, ever attempt because statistically speaking, it's a poor strategy. My specialty, fixed income investing, certainly isn't about timing the market. Instead, it's about understanding that the bond market, along with the stock market, does fluctuate. But the difference is that it doesn't fluctuate nearly as dramatically either on the upside or the downside, which is why I'm able to characterize the headwind we're talking about as somewhat or slight. In fact, you could argue that every headwind in the bond market is somewhat compared to the stock market, which is one of the main reasons that I advocate fixed income investing as a good option for investors over the age of 50, for members of the income generation. In fact, I'll talk much more about that later in today's show, but here's another recent example of how bond market fluctuations can be far less dramatic and far less damaging than the stock market's fluctuations. As you probably recall, right after the election in November of 2016, the stock market shot up, which can be somewhat normal after the election of a new president who seems to be a change agent. What you may or may not realize, though, is that long-term interest rates also saw a dramatic spike, with the 10-year Treasury yield jumping from 1.8% to 2.6% between the election and mid-November. That's even a bigger one-month jump than we saw in January and could potentially have spelled a 7% drop, for fixed income investors at that time. But for the most part, it barely created any kind of headwind for fixed income. The question becomes, well, why not? The answer is because corporate bonds did not experience the same level of sell-off that government bonds did. So as a result, risk premiums compressed. Although Treasury yields went up by some 0.8% during that time, yields on corporate bonds increased by a lot less. Therefore, their values decreased a lot less. However, last month's interest rate spike was different. Why? Because corporate bonds were sold off at a similar rate to government bonds. And this is simply because the money was flowing from the bond market into the stock market as the stock market was creating daily record highs. But let's say that hypothetically, that last month when the 10-year Treasury took its latest jump, the rate took its latest jump, that your bond portfolio lost up to 3% of its value. Even if it were the full 3% loss, the question becomes, how exactly does that compare to the impact of a major directional change in the stock market for buy and hold stock investors? Well, certainly it's a lot different. In fact, to even compare bonds and stock-based investing is like comparing apples and oranges in many ways. In fact, I'll talk about that a lot later on today's show also. The other important issue I'll address later is the question of whether this headwind for fixed income will continue. In other words, are long-term interest rates going to continue rising or level off again like they did after the post-election spike? There are different schools of thought on that. I'll share mine, and then you can decide for yourself. but I'll also explain why any loss in a fixed income strategy is typically only a temporary loss, and one that has, in many ways, very little, if any, impact on the investment's main objective, which is to generate reliable income at a fixed rate. Now, before we get into all of that, I'd like to welcome our first guest, Mr. Dennis Gartman. Dennis Gartman is best known as editor and publisher of the Gartman Letter, whose clients include leading banks, brokerage firms, mutual funds, hedge funds, energy trading companies, and grain trading companies. He's lectured on capital market creation to central banks and finance ministries around the world, and has taught classes for the Federal Reserve's School for Bank Examiners. He's highly in demand as a speaker and market analyst and writes a hugely popular blog. Dennis, thanks for being with us today.
Good to be here. You guys scraped the bottom of the barrel and found me.
No, it's our pleasure. You know, it's funny. As you know, we're here today talking about bonds and interest rates primarily.
Yeah.
But 800-pound gorilla in the room. What the heck is going on with the stock market?
You know, I think that we have to understand that after a 9-year bull market, it's probably time for a year or two of a bearish market. Maybe not that long, but we had taken the stock market to almost preposterously, egregiously overbought levels. We really shouldn't be surprised to see a 10 or 15 or even 20%, for lack of a better term, correction from those highs. I think it may well be even slightly larger than that, but let's understand, stocks go up long before economic activity goes up. Stocks began to rebound in 2000, well, the low was what, April of 2009. The economy did not turn for the better until almost 2010 and 11. That's to be expected because the monetary authorities are aggressive at those times, force-feeding reserves into the system. And here we are now with strong economic environs, and let's not mistake that we are, in fact, in strong economic environs. But now the monetary authorities are taking reserves out of the system, letting the bonds that they had purchased mature. That's a difference. And at the same time, plant and equipment and demand for labor is strong. Money comes out of the capital markets at this time. We shouldn't be surprised by this fact. So I actually think we're in for a bit more of a downward movement in share prices, and we shouldn't be surprised by that.
It sounds like you're saying that you think the economy's strong, it's just that the stock market has gotten out a little bit over its own skis, and now the economy is going to try to grow into the stock market, but still we're going to have some probably continued volatility and some more drops. So Dennis, stay with us. We're going to be right back to talk to you about the bond market, interest rates, and all that. And our Income Generation members, you stay with us also. We have a lot more in terms of great words of wisdom from Dennis Gartman. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. Welcome back to the Income Generation. I'm David Scranton. You know, we've already mentioned that trying to predict the constant zigs and zags in the marketplace is a foolish investment strategy. However, that said, it is important to examine all the possibilities and try to anticipate, as best as we can, changes before they happen. What everyone wants to figure out now, of course, is whether or not interest rates are going to continue rising, or perhaps whether they'll soon level off again. As of now, the 10-year Treasury rate has actually notched itself somewhere over 2.8% and done it for the second time in a week. So first, let's take a look at the argument for why rates should continue rising on longer-term bonds. It all goes back to our old friend artificial stimulus, which I've discussed many times on this show. Specifically, rising long-term rates should continue because the unwinding of quantitative easing still has a long way to go. Think about it. All those bonds that were purchased by the Federal Reserve as part of the stimulus program are in the early stages of being sold back to the public. That, in theory, should again push bond prices down and push bond interest rates up. Other arguments in favor of rising rates include the increasing national debt due to President Trump's tax cuts. Last year, the government auctioned off some $519 billion in Treasury bonds. This year, they're projecting to sell $955 billion of Treasury bonds, almost double. And theoretically, if you flood the market with all these bonds, prices should continue to drop and long-term yields will continue to go up due to that inverse relationship between bonds and interest rates, which I mentioned just a moment ago. In fact, we've already seen in this theory in practice where in January, interest rates spiked from 2.4 to 2.7 on the 10-year Treasury. And yes, theoretically, rising rates should be good for the economy because it would enable the Federal Reserve to continue raising short-term rates with less of a risk of flattening the yield curve. Remember, we've discussed before on the show that the differential between long-term and short-term rates needs to be wide enough to make lending financially worthwhile for banks. With the federal funds rate currently at 1.5%, one could argue the yield curve is already getting flatter because the yield on the 30-year Treasury today is only a hair over 3%. So here's my take on whether or not interest rates are going to continue to rise. I personally believe that the 10-year Treasury may make it all the way up to 3% or maybe a little bit more in the near future, but not to exceed 3.25%. At that point, it's going to hit a strong resistance level or glass ceiling. And I believe that the main reason is you, the income generation. As Americans our age continue nearing retirement, they look for secure investment options. And I believe the rising demand for bonds or bond-like instruments is going to offset the increased supply to stabilize prices and therefore to stabilize longer-term interest rates. Our generation has been burned twice since the turn of the century by a stock market crash, and one more time through a real estate market crash. And more of us are realizing the importance of protecting our assets with secure income-generating investments. So, whether the stock market does go into a long-term dive or the froth on it continues to build, I don't personally believe that it will build at the expense of the bond market. There seems to be enough money sitting on the sidelines that it's going to flood into all markets, especially now that everyday investors have been given a fresh reminder of just how quickly and dramatically things can change in the stock market. And again, the bond market is very different in that respect. In fact, we'll talk about that a lot later in the show. So right now, let's welcome back Dennis Gartman. So Dennis, I know you mentioned maybe as much as 20%, and I don't want to spend too much time on this. Again, we're talking about bonds and interest rates today, but you mentioned as much as a 20% correction. I've followed the lead of a lot of technicians who believe that we need to get below that resistance level that existed from 2000 to 2013 rather, that we might actually have to get back down to 1,500 on the S&P before we really recover from the next bear market. You think that's possible?
Oh, I think it's possible. I think it's highly doubtful. I certainly don't think we're going down that far. The best that I'm able to say at this point is I think that we've started a reasonable-sized bear market, and nobody's going to like my answer to this when I would be asked, where do I think it's going to go? The best I can tell you is I think it's going to go lower until it stops. That's the best that one can, that's what I've learned in 40 years of doing this. So to put a price target and a price time on it, I think I'd rather pass. I simply say, right now, the trend is down and share prices are going to continue to move lower.
And that's what 40 years of wisdom brings you. I love it. So let's talk about the interest rates then. What's your take on long-term interest rates? Do you see they're going to level out soon? Do you think they're going to continue to rise? You know, we talked about that. I gave my opinion earlier on the show. Let me get your thoughts.
Well, first of all, I began trading in the bond futures back in the late 1970s. I had my own seat on the Board of Trade. And I can remember when the long bond, and this is hard for people to believe, but I can remember when the long bond had a 14.25% coupon, and you couldn't give them away. I remember when the 8s of 86, a wonderful instrument, went to huge discounts. If I'm not mistaken, at one time the 8s, a 10-year security, traded at 75% of its par value. So for me to think that we could take interest rates 150 basis points higher than where they are, to think that we could take the 10-year instrument to a 4% coupon is really not that hard, a great leap of disinterest. I think we could get there relatively easily over the next 18 months or so. And if we put a 5 handle on the 10-year, that really wouldn't surprise me. And in a great historical perspective, that's really not that high an interest rate. But
how about the demographics today? I mean, how about the fact that we've got so many people out there there's so much money sitting on the sidelines. I mean, think about what's been happening. Bond prices have been firming up. At the same time, the stock market's been hitting new records every day, in large part because the money's sitting on the sidelines. And as people age, as baby boomers age, they're going to be looking more for fixed income. And that demand, that natural organic demand, has been growing. How do you see that playing into that? Because I see that being an offset, which creates potentially a new norm of lower interest rates. Now not as low as we've seen recently, but not back to 5% per se.
I won't argue with that demographic argument even slightly. It is what will keep interest rates from going back to the levels that we saw in the 1970s and 1980s. Is it going to be difficult to, that tsunami of baby boomer money, and I'm the quintessential baby boomer born in 1950, we do in fact want returns on better than 2%, better than 3%. And we can probably, as I said, we'll probably get the 10-year well above 4%, but that's what will keep it from going to 6 or 7 or 8. The baby boomers needing income and with money on the sidelines and money coming out of the equities market. So rates are going to go higher, but are they going to go visit the levels that I grew accustomed to in the 70s and 80s? No, that's not going to happen.
Yeah, you see, I guess I was looking at it from getting back to a normal value, getting back to maybe 5 or 6% on the 10-year, and then the demographic change really keeping it suppressed below that. But you're saying if it weren't for the demographic change, we could get all the way back to the 1970s, 1980s interest rates. So what would fuel that? I mean, do you see us creating, getting back into the hyperinflationary environment?
No.
Despite the fact that we're struggling to even get 3% GDP, I mean, what would fuel those 1970s rates again in your mind?
Again, I don't think we're going to go back to the levels of the 1970s and 1980s. Can I see the 10-year making it well past 4% and perhaps to 5%? Yes. But again, in the 1970s and 80s, we had 14. That's not going to happen. We're not going to go to those levels again. And it's because of the demographics. It's because of greater productivity. It's because of greater use of computers. All those things are going to tend to keep interest rates lower. Are we going to a hyperinflation? No, not even slightly. We're smarter than that. Even the average person in the public is aware of how money creates inflation. The government is aware of how money creates inflation, and the pressure upon the central banks not to go into a hyperinflationary circumstance will keep rates from going to the levels back in the 1970s and 80s. But rates are going to go higher, just not dramatically so.
Now, in the 30 seconds or so we have left in this segment, tell me, what are your concerns about the new Trump tax plan? Do you have concerns about the amount of debt that we're going to be taking on, what that could potentially do to interest rates? What are your thoughts?
First of all, I am a champion of tax cuts everywhere and all the time.
Great.
When you cut taxes, I think that's a great thing. Do I worry? Quite honestly, I don't worry about the deficit as much as other people do. All I've learned is since the 1980s, the deficit has gotten larger and larger and larger and larger, and yet interest rates have gone down. So I'm not as concerned about deficit problems. Yes, we're going to have $1 trillion deficit this coming year, but where some people may may wail and gnash their teeth, I won't.
So Dennis, let's talk about this a little bit after the break. I want to bring that back up again to the concept of spending your way out. Income Generation members, you stay with us also. We have a lot more from Dennis Gartman.
Hello, I'm Miranda Kahn. All right, let's take a look at some of the stories that moved the markets this week. Twitter shares surged more than 25% after it posted its first real profit. Investors say they weren't worried about having no growth last quarter, which the social media platform blamed on seasonal weakness and getting rid of fake and spam accounts. The overall revenue also went up to more than $730 million, which beat expectations of about $686 million. And CVS Pharmacy announces that it will raise the minimum wage to $11 per hour for its employees. The hike will take effect this April. The company says it expects at least $275 million this year, courtesy of the GOP's tax bill. Last year, CVS said it would buy health insurer Aetna for $69 billion. And for much more on these stories, visit newsmax.com/finance. Now back to the Income Generation with David Scranton.
Thanks, Miranda, and welcome back to the Income Generation. You know, as the market soared in January, Some of you may have heard from friends or family members who are bragging about making a killing on their portfolios. And yes, maybe they indeed felt that way, but in reality, they were taking a pretty simplistic and short-term view of their investments. The real reality is that since the year 2000, thanks to two major market drops, stock investors have experienced an average annualized return of just over 5%, despite any other temporary killings that they may have made during that time. By comparison, fixed income investors have also seen average returns, oftentimes in the range of 5 to 6%, keeping in mind that total return is both a product of growth and income. Remember, stock-based investors are focused more on the former, while fixed income investors are focused more on the latter. And after all, what about those two major stock market drops that occurred since the turn of the century? Well, they offer another example of why a loss doesn't mean the same thing for income-based investors as it does for stock-based investors. Consider that. With interest rate spikes we've been discussing, we've been talking about resulting losses in the 3 to 7% range. Now consider that stock investors saw their portfolios drop by nearly 50% in the 2000 to 2002 correction, and by almost 60% when the markets fell again from 2007 to 2009. And let's face it, that's the kind of loss that can be really damaging for someone who's retired or within 10 or 15 years of retirement, which again is one of the major reasons that I advocate fixed income as a good option for investors over the age of 50. Mathematically speaking, a temporary 3 to 7% loss is certainly preferable to the alternative, especially when you consider that it is in fact temporary and ultimately not a real loss. Which leads me to the most significant and important difference between a loss for bond investors and how it's different from stock investors. And that is that a loss in the stock market is a real loss. Why? Because you're not investing by contract in the stock market. What do I mean by that? Well, you see, when you focus on fixed income, a temporary drop in your portfolio's bottom line is largely irrelevant. Why? Because your principal is often contractually guaranteed to be repaid by the issuer if the investment is held to maturity. More importantly, it's guaranteed by the issuer to generate income at a fixed rate regardless of fluctuations in the market. So you may not ever make a killing with fixed income, but you're also not going to risk financial ruin. And your investments are serving their primary purpose regardless. But for now, let's welcome back Dennis Gartman. You know, Dennis, you said, it sounded before the break as though you were leaning toward the philosophy that says that, you know, we can borrow more money because we can grow our way out of this. But, you know, I get a little skeptical of that because I think about, you know, if I had a large load of goods that I had to tow with a pickup truck, and let's say I had a quarter-ton pickup truck, and it really couldn't get that large load of goods moving. So I took a 1-ton pickup truck and I hooked it up in front of the smaller truck. And between both of them, I was able to get the momentum going. Once the momentum went, I could detach the 1-ton truck, and I'm sure the quarter-ton truck could keep that supply moving because once we have kinetic energy, it's easier to keep it moving. But eventually, that quarter-ton truck is going to run out of fuel. And it's going to have to stop, and it's going to have to start the momentum going again. And that's what concerns me about the concept of spending our way out of the debt, or I'm sorry, growing our way out of the debt, is that eventually we're going to have a recession, but now we've created a bigger load that we need to drag around in the next recession. Your thoughts?
I can't argue with you. I mean, it's exactly what shall happen. All I know is I was told when I was in undergraduate school in the 1960s that higher deficits gave way to higher interest rates. And all I have seen in the course of the past 40 years is that higher deficits have given way to lower interest rates. Mm-hmm. Now, we argued earlier on that I think that interest rates are going to go quietly higher for the next several years. But the correlation between deficits and interest rates seems to me to have fallen completely apart. We can, in fact, grow our way out of most deficits. What our problem has been in the United States is that when we have cut taxes, which I'm a proponent of cutting taxes, we have simply not done the right thing and cut spending as we should have. There will come a time, you are absolutely right, when the truck will stall and go backward. Mm-hmm. There shall come a time when that shall happen. But I was told that it was going to happen in the 70s. I was told it was going to happen in the 80s. I was told it would happen in the 90s. I was told it would happen at the turn of the century. And I've been told now it's going to happen in the teens. Mm. It hasn't happened yet. It'll happen sometime. I'm not going to lose sleep waiting for it to happen.
Well, as you know, Dennis, what's going to happen is Bitcoin is going to become the world reserve currency, right? We all know that. I mean, everybody knows that. And then that's what's going to happen, right? So I think we just answered our question, right?
Well, let us hope that the Bitcoin does what it should do, is disappear into the ether, to make a very bad cryptocurrency pun. I have been on record saying that I think that Bitcoin disappears and goes eventually well below $1,000 a piece, because it doesn't make sense to me. But that's another story for another time. We'll pick that up at another time.
I agree completely. So, all right, so what about the Federal Reserve? You know, let's say that if you're right, we're okay. If you're right and yields go back up on the 10-year, let's say to 4%, that gives the Federal Reserve more room to raise short-term interest rates and without flattening the yield curve. But let's say that it takes a while, and let's say for the next couple of years that I'm more correct, that maybe we stop in the low 3s on the 10-year. Is the Federal Reserve going to screw it up? Are they going to keep raising short-term rates at the risk of flattening out the yield curve?
Let us hope that the Federal Reserve Bank has learned the lessons of its own mistakes in the past. All recessions in the United States in the post-World War II period have always developed after the yield curve has inverted, where the overnight Fed funds rate has gone to a premium over the 2-year, which has gone to a premium yield over the 5-year, which has gone to a premium yield over a 10. Let us hope that the Fed does not take the yield curve to an inversion. I doubt that they shall. I think no question about it that that the overnight Fed funds rate is going to make its way probably eventually to 2.5%, 3%, maybe even 3.5%. But that shall happen when the 10-year has gone to 3.5%, 4%, 4.5%, maybe 5%. I hope that the yield curve remains positively sloped, because that does benefit the banking system. It's the best thing that can occur to keep the economy moving forward. Let us hope the Fed has learned the lessons of its own creation in the past.
Yeah, that's my big concern, is based upon my interest rate crystal ball, that I'm afraid that could happen. So in some ways, I hope your interest rate crystal ball is better. But tell me, in the last minute or so we have left, our viewers are income generation members. They're all 50 and over. Yes. We both think the stock market's going to go down. Obviously, there's a headwind created for fixed income if interest rates continue to rise, as you believe. So where is somebody who's retired or close to retirement, in your personal opinion, to put their money today?
There's a number of ETFs, closed-end bond funds that exist on the New York Stock Exchange that pay 7%, 8%, 9% yields with dividends that are paid on a monthly basis. I keep putting a great good deal of what I own into those instruments.
Are they interest rate hedged?
No, they're not interest rate hedged, because most of the time their duration is only less than 5 years. And there's a number of them. There's probably 10 or 15 of them. I don't want to mention them on here, because that brings the SEC into consideration. But I tell people, call your broker, call the brokerage firm, look into the Wall Street Journal, go to the web and find them. But when you get paid a dividend on a monthly basis, it really adds up over time. And the duration, go ahead.
Bottom line, as I always say, invest for income. Make the paradigm shift from growth to income. Be more conservative. Dennis, we're out of time. Thank you very much for being on the show today.
I was honored to be asked. Thanks for having me, and look forward to doing it again sometime in the future.
And you don't go anywhere. Stay with us. We'll be right back. As I've discussed many times before in the show, in my experience, most people have what I call purpose-based retirement goals. In other words, they want to be able to pursue their favorite pastimes, whether it's travel, visit family, whenever they like. They like to go out to dinner and generally enjoy life to the fullest without having to worry about a major financial loss. Also, in my experience, most people want to be able to finance those goals through a regular income stream. All of this is the main reason why I've been specializing in fixed income-based investments and strategies over 20 years. Years that have included 2 major stock market crashes of over 50%, by the way. That is 2 so far. Naturally, everyone wants their money to grow and increase in value whenever possible. And, as I pointed out many times, investing for income doesn't necessarily mean sacrificing growth. Active management allows the fixed income specialist to take advantage of growth opportunities when the fixed income winds are in their favor, as well as mitigate losses when facing headwinds. And when favorable winds return, and they always do, losses can often be recouped and growth can continue. The important point to keep in mind is that regardless of any temporary headwinds, you can count on your assets to continue generating the income you need to enjoy retirement and achieve your financial goals, which is exactly what fixed income investing is all about. Now, speaking of investing for income, our next guest may be able to tell us a thing or two about investing in real estate for income. Logan Mohtashami is a financial writer and blogger who covers the U.S. economy and has a special focus on the housing market. His work has been published in Business Insider, Benzinga.com, and his own highly respected blog called The Financial Truth. He's well known for his highly accurate forecast articles and his predictions on the health of the housing market and the mortgage rate trends. Logan, welcome.
Pleasure to be here.
So, what's your take about rental property? You know, it seems today that, you know, a lot of the younger generation today are not anxious to buy homes. They're renting more. Seems to be a demand for that. It's a good way for people to get income who want it, other than the traditional types of things that people like myself tend to invest in. Where are those markets right now?
When we're talking about rental demographics, you know, 2008 to 2019 was very favorable for renting in this country. Mm-hmm. We were very young and we were very old in this cycle, so the demand for renting was very strong. And on top of that, after the financial crisis, over 8 million people lost their homes either through foreclosure and short sales. That also added another layer of demand to the rental market. And in this sense of a low interest rate environment, rental yields have been very favorable for those who have the ability to buy homes with cash and rent them out.
Okay. Now, how about, and I don't want to get too far off on this tangent, but I've got to get some free advice from you here. And I apologize for all of our income generation viewers for this. But while I have Logan on here, I have to know, you know, I bought my house here in Florida during the financial crisis, negotiated a really good price, and now it's up 50%, 50. You know, should I sell? Should I rent for a couple years? You know, you don't really win anything unless you take money off the table.
I think what people should look at, if you really want to take a look at if home prices are about to fall, look at monthly inventory, especially on the national level. If we start to head towards 6 months inventory, then pricing power is going to change to the negative. But still right now, inventory is low. Real home prices are not back to 2006 levels. And as long as interest rates are below 6%, real interest rates and real affordability is not the same as it was in 2006 when real home prices were really high and interest rates were still 2% plus higher back then. So the home price cycle still has some legs left in it.
Okay, so don't sell now. You can squeeze more out of it and watch the trend. Got it.
Watch monthly inventory. That's your ticket right there for when prices are going to turn.
Okay, so now you've mentioned interest rates and mortgages. So how about mortgage rates for people that are watching, they're looking to buy another home, looking to take a mortgage? You know, mortgage rates are going to go up, but how much do you think? Where do you think interest rates are going to level out?
I don't see interest rates going too much higher than where we are right now. The 10-year yield has been in a basic range of about 160 to 3% for majority of this cycle. And even right now, when the 10-year bond is selling off, mortgage rates still are not near cycle high. So unless oil prices and world trade inflationary things pick up much stronger than they are right now, I think we hover around this level for the rest of the year. I don't see too much higher mortgage rates than where we are right now.
You know, I don't know you well, but I seem to like you, and I also like our previous guest, you know, Dennis Gartman, except that I like you just a tiny bit more because I agree with your interest rate philosophies. I think that interest rates are going to stay maybe no higher than low threes for actually a few years before things turn around. So stay with us. When we come back, we're going to talk a little bit more about interest rates, and we're going to talk about how they can affect the bond markets. And Logan, I'm looking forward to getting some of your predictions. And you stay with us also because as income generation members, you know, if you follow Dennis Gartman's advice, you're investing for income, you're going to want to know where interest rates are going. So stay with us. We'll be right back. Welcome back to Income Generation. We're talking with Logan Mohtashami. So are you thinking that we're going to be in another maybe Japan-like environment with relatively a new norm of lower interest rates for a while to come? I mean, not necessarily in the low twos like we've seen, but is that kind of sort of what you're thinking?
I think demographics and technology has killed inflation, and in an aging society like we are, it's going to be very hard for a lot of older countries to create inflation, and that's the story around the world for mature economies that have a very older population. So I don't see rates rising or year-over-year inflation growth to be very strong for a long time.
So I'm glad. I have to tell you, I'm glad. Woo, whew. Because all the talking heads you talk to sometimes are always saying, oh, there's a bond bubble, there's a bond bubble, there's a bond bubble. Of course, they're assuming interest rates are going to go way up. And, if there's a bond bubble, then perhaps I need to change careers. So I'm glad to hear you're not predicting that.
If you can find me a bond vigilante, I'll find you Bigfoot.
I love it. So, okay, so maybe we are in the new norm. That's great. How about the Federal Reserve? Do you have any concerns, as I do, about the Federal Reserve perhaps being silly enough to continue to raise short-term interest rates and flattening out the yield curve in light of all these pressures we have to keep rates down on the long end of the curve?
Well, if the Federal Reserve was following its own advice by having that 2% PCE core inflation as the target, they're not following it. PCE core inflation came in at 1.52% growth. So I think they're more afraid about not having enough Fed rate hikes to cut down in the next cycle, because as of now, core inflation under their own metrics has not hit their targets, and they're still raising rates. So we'll see how they go for the rest of the year, but I'm looking hopefully for just 2 to 3 rate hikes, maybe at most, but I think 4 rate hikes would be a little bit aggressive unless core inflation really took off with oil prices taking off and world trade going up and wage inflation, all 4 going together. But I just don't see that as of yet.
I agree completely. I think they're in the gun store buying more ammo is what they're doing for the next recession. So that makes sense. But in the 30 seconds or so we have left, tell us the national debt. I'm a fan of President Trump's tax plan for the most part, but what does that do to our national debt, and what does that ultimately do to our country? What's your take on that?
I'm not afraid of the national debt, just because I look at it this way. Federal debt has been rising for 4 decades, and interest rates have been falling. When people say we have $20 trillion of national debt, I always say we are a $120 trillion GDP national financial asset country. We have the reserve currency of the world. We do have a prime age labor force that's going to grow. So I don't believe in the theory of currency-induced inflation, but politically speaking, at some point, politicians will try to either raise taxes or cut spending, and it's more of a political fight. But currency-induced inflation based on rate...
But not a big concern at this point.
No.
Interesting. Okay. Well, Logan, thanks so much for joining us today. We are out of time. I really appreciate you being with us. I'd like to take this opportunity to thank all of my guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. As another wild week in the financial markets comes to a close, I hope you'll remember a few takeaways from today's show. First, that what we've seen in the last couple of weeks and since the beginning of the year is nothing new. The stock market, the bond market, interest rates, they all zig and they all zag. And sound investing isn't about trying to predict and time those zigs and zags in order to play or try to beat the market. Second, that sound investing is about understanding different markets and understanding that they fluctuate in very different ways and to different degrees. And that, in general, the bond market doesn't fluctuate nearly as dramatically as the stock market, either on the upside or the downside. And third, that a loss for fixed income investors doesn't necessarily mean the same thing that it means for stock-based investors for a number of reasons. And fourth, that because fixed income investments are contractual, almost any loss is only a temporary loss. And most importantly, it doesn't impact your investment's main objective, which is to generate the income that you need to enjoy retirement and to achieve your goals. Thanks for watching. If you're close to retirement and really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on The Income Generation. I'm David Scranton, and thanks again. We'll see you next week. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.